So you guys have been sending in a lot more great questions for us to answer, and I want to respond to a few of these right now. I drove to Arizona the first week in December 2019, paid $95 for use of their contracts, sold a house in Tucson, Arizona, did all the inspections, etc., and drive back to Dallas, Texas. We didn't close escrow until January 26, 2020. I had gas, mileage, and 2 hotel bills going to Arizona and coming back to Texas. Question: can I take gas, mileage, hotel bills this year, and commission paid next year? To answer the question, most people watching this in real estate are going to be what we call a cash basis taxpayer. If you're a cash basis taxpayer, that means that the money you earn in a particular year is taken as income in that year. Furthermore, expenses you incur in a given year are taken as expenses against the income that year. There's 2 types of basis for accounting. One is cash and one is accrual. Cash basis runs the way I just described, while an accrual basis means that you actually accrue income and expenses. So if you were to say get an invoice in 2019, but didn't get that invoice paid until 2020, it would have counted as income in 2019. In most cases in real estate, you're never going to run into this. So really you only need to worry about the cash basis. So to answer Teresa's question, she would declare the income in the year it was received and take the expenses in the year in which they were incurred. Now, what this also means is that if you wanted to say take an expense that you're not normally going to incur next year, this year, all you would have to do is technically pay for that expense in the year you want to take it. Sometimes what clients have done in the past to get their expenses up in a given year is actually pay for their tax returns the year before. That way they can take that expense even though it's next year's tax return. So Gail writes, interesting information. I have a number of clearly defined categories previously provided by my CPA. However, he lumps things like staging, floor plans, photographer, and food into miscellaneous expenses. He's very conservative, and I tell him that if he thinks my number is too high, even if I have receipts, he can reduce the number rather than call attention to it. There's actually 2 things I want to address in this. One is the usage of the term miscellaneous expenses on a tax return. See, this email was written to me in response to a recent written email that I'd done in which I said that putting miscellaneous or other expenses on your tax return was a risk. Because when somebody looks at that, what does it even mean? If I look at a tax return and I see other expenses and there's no supporting documentation, my first thought immediately is, oh, someone just had a bunch of extra stuff they threw on here, but they didn't actually account for it properly. And to the point of accounting for things properly, I also want to address the last thing there about lowering the number if he thinks it looks too high. It's not about the numbers looking too high or looking too low. It's about the numbers being correct. When I hear people talk about how they reduce their numbers because it looks too high, my automatic assumption when I hear that is, oh, they know their stuff isn't correct, so they adjust it down to make themselves feel better about it. And more often than not, that is the reality of the situation. I can't tell you how many clients I have who said similar things to me when we brought them on, and then when I look at their returns, they're not even safe because they're not even following the rules. It doesn't matter if you're artificially lowering your numbers to pay more taxes. At the end of the day, either the information on your tax return is right or the information on your tax return is wrong. Nevertheless, this was a great letter, and I'm grateful that Gail gave us the opportunity to address this. So Gilbert writes, I'm interested in Pennsylvania. That's where I live. So this is actually a great email because there are a lot of state-specific things that we can talk about, and I'm going to give you a few different ones here. Now, as far as Pennsylvania goes, I'm actually from Pennsylvania originally, so I know a thing or two about that state. One of the things that's unique about Pennsylvania is that it's a state where you're usually going to have 3 different tax returns every year: federal, state, and local. Most municipalities in Pennsylvania require you to file a local tax return in addition to those other 2. Additionally, Pennsylvania, much like New Jersey, is a very interesting state because it's a state where you actually can't have real estate commissions issued to an LLC. They have to be issued to a person. This leads to complications for a lot of people who try to set up an LLC to run their commissions through in Pennsylvania or New Jersey. Now, likewise, there's a couple of other states that I have interesting things on. Remember with all this that I can't give you legal advice, and this is not a legal channel. It's very important to talk to an attorney in your state about all of this, because every state is going to have different legal implications of what you can and cannot do. A few other examples that I'm familiar with are California and Arizona. In the state of California, real estate brokerages can't really really run with an LLC. They all have to run with incorporation instead. Now, Arizona's pretty interesting because in Arizona, real estate professionals can't use a regular LLC, and instead they use something called a PLLC. So this is why it's so important to consult with an attorney in your state when it comes to setting up a business entity. Because the business entities are created on the state level, every state has different implications from a legal standpoint on what you can and cannot do with them. It's important to know them all when you're setting things up. That's about going to do it for this video. I'll see you in the next one.